Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Really glad everybody could join us today. We are trying to help you with your retirement. You can send in questions. That's what we're trying to answer here. Really love to get those questions. You can send them in now, send them in during the week so we can answer them. I will say right up front here, we won't be doing the show or a summary for the next 2 Fridays just because I'll actually be out of town. So we'll get back together again, a couple Fridays from now and do the show again. But, send in your questions now if you'd like. We try to answer them live. You can put them in through the email there that you see here on the screen, or you can actually put them into the chat and we'll try to answer those. And then obviously if you want to subscribe to the channel, not a bad idea. The object of this whole thing is just to try to do education. So there's a bunch of different videos on there I think you might find helpful for different situations. And then of course, if you just want to meet with Ethan and I and ask us questions on a personal basis, we can do that too. There's a book appointment button, looks just like that actually, that's up on the corner of our website. The link to the website's here on the page. You can go to that too. And so look forward to being able to help people today. We get questions on a consistent basis, and we especially get questions in our client review and client strategy sessions that we have that we'll be covering some of those today also. So all right, so I do like to start off every week talking about what we saw as a kind of a summary for the whole week in the market. I put out, a daily video on most days, but then on Friday I try to kind of summarize what we saw. And so, of course, we have our chart here up to date as of now. Market's doing well.
Yeah, it's a solid week.
Solid week. It's been a solid recovery actually all the way through since the pause, right? After the Liberation Day. It's kind of amazing because, a lot of those tariffs are kind of back on again, maybe not quite the same height, but still higher than we've seen since 1910. These are pretty high tariffs. And that's part of what happened this week, right? We had a pretty good jump based on what was just set up with Japan, right?
Yeah.
So a 15% tariff for incoming, cars for the most part. I think that's their biggest, but from incoming products from Japan, and it was 1.6% prior, so it's a pretty big jump. And supposedly they're going to open their markets more to our products. However, I don't know how that's going to go. There has to be a demand there, an interest in those products too.
I think the market's been open to U.S. autos for a very long time, but it's just not very much demand from Japan, just because U.S. cars just are too big a lot of times in Japan.
Yeah, and the market responded positively. You think about that, that's kind of wild. We went from 1.6% tariff to a 15% tariff. It really kind of hammers the domestic auto manufacturer because they're paying 25% tariff on a lot of their parts, plus 50% tariff on some of their inputs like steel, aluminum, and copper. And so Japanese cars could theoretically be cheaper coming in from outside the U.S. Than U.S. cars are for people that are buying them in the U.S., which is exactly the opposite of what was intended.
Yeah, but I think it's a lot of the market just wanting certainty. With that, at least with that deal, we know what the rates are going to be. We can figure out how it is going to affect earnings for the companies that need Japanese products. And so there's some sort of certainty that the market's looking for.
Yeah, and the market is a betting mechanism. So the threat was I think it was 25% tariff, correct? And so, the market looks at that as a probability. Okay, what's the probability that we actually end up at a 25% tariff? There's some probability, it's not zero. And so then all of a sudden you end up at a 15% tariff. Okay, now that's better than 25, all right? So the probability, is now erased and we know what it is, and so that certainty's there. Whether or not it creates all kinds of problems, we'll see what happens. But the market did respond positively to that. Earnings have been happening this week. I know Tesla had a rough earnings quarter and expected, according to Musk, to have some more, rough earning quarters coming up. But we saw decent numbers out of Google, which really drove the market that one day. For all intents and purposes, I think Google was the main piece that helped there. And then AMD came out, and so there's been some good earnings. We've had good earnings for a really long time, going back to 2020. We've been able to kind of beat expectations by 70+%. That I tell you what, the analysts that are following these companies are just historically underestimating what these companies will earn and what the revenues will be.
We're starting to see some tariff implications.
Mm-hmm.
Some of the car companies have come out and stated how much their tariffs are adding to their cost.
Right.
And so we'll start to see, and also Kroger was another one.
Yeah.
So we're starting to see some sort of tariffs coming into the pricing and cost.
Yeah, that's a good example. So GM said, I think, a $1.1 billion loss due to tariffs. Stellantis, is that how you say it? The company that has Chrysler and what have you, was a $2 billion loss in the quarter for tariffs. Kroger was, I think, around $1 billion loss from tariffs. Basically, they didn't pass along those increases. Kroger was last week, but they didn't pass along those increases to the consumers, so they took a hit on the bottom line. And yeah, that's exactly what we're seeing, is kind of that first little piece. Now, here's the key that's kind of important. As an investor, the stock market still went up, right?
Mm-hmm.
Even though those companies were reporting those particular pieces, because they're not big pieces of these indexes, right? If you owned Kroger, I think it dropped 5% or 6% that day on earnings basis. Those types of things. We did see some, crazy thing like Chipotle dropped 13%. I think that's their worst drop in a single day yesterday. And, so there are some pieces that's always out there that's going on. But the mood in the market is definitely positive, right? So you're getting away with some of these other things that are happening. Now, what's the cumulative effect of all of those losses, or eventually, because those companies aren't going to lose that much money. There's no way that a car company can lose $2 billion a quarter on.
It's actually $2.7 billion.
2.7
for the half.
Oh, for the half, okay. Yeah. But still, that's what, 5.4 annualized? That's not going to happen. And matter of fact, you'll get sued to death by your shareholders. So, eventually they'll push this through. And I do think that's what we're seeing now, is that these deals, maybe they're not the solid deal like you'd really expect. Some of those take a long time, but at least the framework of the deal being presented at, say, 15%, 19% on the Philippines, all of those types of things. And the rumored 15% on Europe that we haven't seen yet, but theoretically they're trying to get there before August 1st. All of those things are, what's the cumulative effect going to be if companies all absorb those, which, again, they won't for very long. But the problem would be, the stock market eventually takes a beating there, just because if every company out there that's taking a hit on these things, they'd start hiring less, laying people off, restructuring, and then that's the cascade. So you get a company like Google, which theoretically isn't really impacted directly by tariffs, I guess, except for their phones.
They don't. They have some physical products. You have the Nest products and all that kind of stuff.
Yeah, that's right, Nest.
But a lot of their stuff is software and ecosystem, right?
The
technology ecosystem. So those don't get affected. Their ad revenue won't get affected.
Right. So that, there's these direct impact companies, and they're the ones we're going to see first, right? Yep. Which we're seeing now. And we're going to see more of those, and by the fourth quarter, we'll see a lot of those, in my opinion, just because we won't be able to hold back. And so the auto manufacturers are a great example. So, and then there's these other companies that are insulated from it, and so there's a lot of money going to be going towards those companies. The way that those companies could be impacted is just the overall economy starts to fall apart, then, ads sales drop at Google or whatever, and they've got some good diversifies, but almost nobody makes it through, a recession, if we have one, unscathed, unless it's some really strange company that's designed to do well in a recession, which is not what we're talking about here. And so that's why. So maybe Apple, I think is only up 5% or something in the last couple of years. Yeah. And so it's got a lot of exposure to tariffs, right? Versus, say, the Googles of the world, and maybe Microsoft also probably fit in that same category. So those are the areas that I think are somewhat insulated, at least up front. And then it depends on, what happens and how much impact these things have, right, on the economy. Because normally if prices are going up, like during the 2022 when prices went up, companies made more money.
Yeah.
They made record money. So they basically used it as cover, right, to increase they were coming out and saying, hey, we have to increase the price of our product because there are inputs or labor's costing more. Okay, that's fine. Then you wouldn't have record profits. There's just no way. I mean, right? You would have even profits or less profits because you're seeing this increase. So, and this has been true historically in inflationary time frames. Okay, companies do well and earnings do well, and you'll basically see that snap like we saw in 2023 as those earnings continue to come through. But with tariffs, inflation's coming through, prices are higher, which always means less demand. Okay, and almost unless there's elastic demand, which is not very common but is possible. So you're going to see a drop in demand, and these companies aren't making that higher price. They're charging that higher price because of these tariffs. And so this money's just getting sucked out of the economy, worldwide, actually. And so that'll be really interesting to see how that plays out as far as that goes. And so I've got a piece here that I think is interesting, just looking at kind of the inflationary impacts and when they might be coming. All right, so if you look... All right, so this is I think one of the better leading indicators of price. All right, and this is the ISM Manufacturing Prices Paid Index, and what this is just essentially, are you paying a higher price now versus say last year's same time or less? Right? Yes or no. So we're up to 70% yes, which goes back to the 2022 time frame for when we had that last, and I'm going to show you a chart here as an overlay just to kind of make it. So I'm going to take the orange part of this chart is that same ISM, reading. And you can see the big jump that's happened in 2025 here at the end. The purple part of the chart is the core PCE inflation index, right? So that's what the Fed's looking at. Now look at the very beginning back in 2021. It went up way higher than the PCE, sorry, and then PCE caught up. So it's a leading indicator. Now, if you look at it, it can take a while to really jump in there. And then eventually, it's also a leading indicator to the downside. See how the orange line started down before the purple line started down?
Yep.
So it's another great indicator of where prices are going to go as far as that goes. And so this is, again, just starting. We're seeing it on the manufacturing side, and eventually, and some of that's getting absorbed by manufacturers. Some of it's getting absorbed by the ultimate reseller like Kroger, those type of things. That eventually stops. Some of the inventory that's still out there gets sold out. Right. I've been saying for a while. It's August, September, October is really kind of when I think all of those things come together, where the inventories dry up, and then the companies give up on trying to absorb it themselves. I would think you'd want to absorb it yourself if you thought it was going to be short term.
Yeah,
right?
If you think it's a temporary issue where tariffs will be there for are just going to be for a couple months and then go back to normal or like much lower, then you just eat the cost.
Yeah, exactly. But I think these trade deals are probably putting a nail in that coffin to a certain degree. When you've made a deal with Japan and at 15%, and the Philippines and UK and China, they got a sort of a deal. I think it expires August 12th, the one that they have now, so they're working on that again. But they've got a framework that they're talking within, so you're starting to see more permanence, at least until things fall apart, if they do, with these tariffs. And so I think that's what that's going to mean, is that these companies are going to start passing this through even faster. I mean, if it's not going to be temporary, then hey, let's move on. So, but this is we'll keep pulling this chart up actually, and to keep looking at this, because this is the leading indicator for kind of the inflationary pressures that might happen. But I have something interesting I want to talk about here, because I think this is very fascinating. Right now, the Federal Reserve is talking about really staying put and wanting to see more data, and what's the impact to inflation for this situation with the tariffs. So normally, when you lower interest rates, it ups the demand, and if you lower them too much, it'll up the demand so high that you start to get inflation, right?
Because you can't supply enough.
Yeah, you can't supply enough. We saw that after the pandemic, just because the supply wasn't there. But this situation, if you have inflation, it isn't possibly because of higher demand. It is simply because the tariff.
There's higher costs.
It's a higher cost. Now that does impact, what you're going to do in terms of, you're going to see demand drop in those situations. So, but that's important. So prices go up, in essence, artificially. Without high economic activity, prices go up because of tariffs. And then all of a sudden you've got the situation where, the economy starts to slow down because the demand is dropping down because of the price increase. And I think the Federal Reserve, at least from what they've been saying so far, is going to look at this and say, hey, prices are going up. We're not going to lower rates. And they are looking at labor, which is their other, mandate, dual mandate, low, unemployment and low inflation. But labor is a lagging issue. And so that's why they're always late, actually, if they're looking at labor too closely, because labor takes forever for people to get laid off, even in bad economies. And so I wonder if there isn't some room even now or very soon to start doing some rate cuts on the anticipation that the tariffs are going to slow down the economy and try to get ahead of that a bit, with the idea being that you're probably not going to stimulate inflation even higher if the economy is soft, even if you are putting in rate cuts. And so I think there is some room for rate cuts personally. And the other thing that I think is interesting is the economy, and mainly is AI a big enough driver to overcome all of this? Can it overcome the whole issue with the tariffs, for example, and deportations? And yeah, we have high inflation, but it doesn't matter because productivity is growing so quickly. Company earnings are still flying. And in the end, earnings are the number one key to the market going up, period. I mean, it's just the way, no matter how it gets there or what we think about it or what we like or don't like, earnings are the key. It's the strongest correlation, the stock market. So is it high enough? So I think back to my experience in the dot-com bubble, 95 to 2000. We had exactly the same conversation. I mean, exactly. The internet is going to be this massive productivity gain. And it was, right? I mean, definitely right. And look at this. I mean, we're here today. In 95, we wouldn't be doing this.
Yeah, we're streaming across the internet.
Yeah. And so it's been phenomenal. But the market dropped 45%. Now, this was after this, kind of bubbling effect. I don't feel like we are there yet. But we are, in the overall pattern, it is what you have to watch for. Because there was a comment actually in one of the videos I put out. The AI and the productivity is going to overcome, essentially. And I agree long term, but in the short term, the stock market can get so far ahead of itself that you end up with these massive corrections. And just because there's a leverage right now, the one thing that's going up a lot is margin accounts are going up a bunch. And so people are jumping into this. There's a bunch of money to be made in some of these areas. You got some of these, meme stocks are coming back around again. I guess Krispy Kreme, and what was the other one I saw the other day? Anyway, so that type of craziness is still happening as far as that goes. So there's some frothiness that's happening now, in my opinion, and we'll see how that goes. But nothing like we saw at the end of the bubble in 2000.
Yeah, but usually when any kind of emerging technology, there's always like that hype cycle in the very beginning before anything's kind of. I think with this one, we're trying to see where the revenues actually come from these AI companies.
Yep.
There's a lot of AI companies out there, but how many will exist and how many will have a successful product with revenue is another issue.
Oh, yeah. I mean, so there's all these parallels, because if you go back to the early 1920s, I think in the Detroit area alone, there was like 2,000 car manufacturers. And so there's, 3 ended up surviving. If you look at the dot-com thing, it's the same thing, thousands of dot-coms. And Amazon and, these companies that came out of that, right? I mean, and so the same thing will happen with AI. There'll be all these different companies who will come out of it, who won't come out of it, that type of thing. But that's the same thing we had. So in 2000 run-up in that 5-year period, we didn't have this type of technology. It was just something that was there. The internet was, we were on dial-up with AOL. Even at that time, it was pretty clunky. I mean, compared to where we are now. And so again, it just kind of got to a pricing point where it could see today back then, and it started to do, and it just wasn't there. So the reality starts to kick in So that's the same thing that's going to happen with AI here. It won't be enough revenue to be generated out of that, even on a productivity basis, to support the crazy levels that the prices could get to, right? And so, that's where you kind of have that take back component. But eventually, the market's probably right, and the pundits and the future, looks very good with this particular technology, and things do play out. But it's just a human nature thing, this kind of tulip mania that happens, that comes along on a regular basis. So I think it's a very fascinating market. The cross currents that are going on. I mean, it was fascinating before the whole tariff and deportations and all the different things that are happening as far as that goes, and it is even more dynamic now. And so I think that's the battle that's going to play out here, especially for the second half, maybe for the next 12 months altogether. You know, is it big enough? Is AI big enough to make up the differential? And I do remember some stories from 2000. I remember there was a guy on the radio once, because Google came out and went public. It went very hot, right? And they were the new search engine. I don't know if you guys, I'm dating myself, but we all used Yahoo prior to Google.
Netscape, Yahoo.
Yeah, Escape. There's one that had a black lab. I can't remember what the name of that was. Anyway, and Google comes along. They have a better algorithm, basically, is what it came. You got more answers more often. They didn't have any revenue, period. And I remember this guy on the radio says, I will eat my hat if they get to $500, which was probably 25 splits ago. And so it's obviously a good investment. Same thing's going to happen with AI. Where's the revenue generation coming from? And I will say these companies in the end, they're pretty good at figuring out where that is. And because Facebook didn't have any revenue generation, now it obviously does, right? And so there's always ways to do that. So anyway. I do think that's going to be a part of this, but that's more that next phase that would come along, where these companies are, like Amazon and Google and what have you, in size and in structure. I will say that this, productivity gain seems so severe on the AI side that there could be an employment issue that comes along with it. That wasn't talked about as much in the 2000 .com bubble. Like, computers are going to replace people. They did. I remember we had 2 people here just to rebalance our portfolios. It would take 2 weeks solid for 2 people working basically manually back then to rebalance all of our accounts. And now you have software you can do. One person can do it in an hour, hour and a half, and so, obviously I don't need 2 people anymore. I can use one portion of one person. So and we survived that, but the AI, jump seems bigger in terms of productivity gain.
Yeah, it can do a lot more, and it's more advanced, and so we'll see.
Yeah, and what I'm reading is about how fast it might come at us, faster than people are expecting, and so I think that'll be interesting to see how that plays out in the labor market, because we're already hearing rumors, at least, of some of these tech layoffs, like with Microsoft laying off, and they're calling them an AI layoff. Whether they are or not, I don't know enough about it, but it's something that's circulating out there as far as that goes. So that's another dynamic that could play out over this next 12 months, and I'm starting to broaden my horizons past the end of the year, because I think a lot of these things are going to take some time to really have impact. We could have a great stock market before there's any real impact from a lot of these different areas for quite a while here. And, right now, I think the setup is good for a decent market going forward. I just don't know how much longer. Is that a month? Is that 7 months, 10 months? When does the impact of these tariffs start to eat into these things, if at all? And are these other areas strong enough to carry the day, right? So anyway, that's what's happening so far. It's a really fascinating time frame to be talking about what's happening in the market. Great time to be learning different things, in my opinion. And so again, there won't be another summary for 3 weeks. 3 weeks from now, we'll have another summary. But hang in there. We'll see what happens as far as that goes. Again, generally speaking, the summer starts to get soft. It should have happened already on a seasonal basis. Usually the peak is the 17th of July, and here we are on the 25th, still rolling. Yeah. So different year, definitely. Everybody's talking about August 1st. When everybody's talking about something, it almost never has a big impact on the stock market. It's never those things that really scare the market. So, we'll see what happens. But anyway, thank you for listening to this summary this week, and we'll look forward to talking to you again in about 3 weeks. Okay, good. So what do we have for our first question?
So, what are the pros and cons of having alternative investments in a 401k? It, last week it was proposed there's going to be an executive order to include crypto, commodities like gold, and then private assets as available investments for 401ks.
So private assets being private equity, yeah.
Private equity, private credit, hedge funds.
Oh,
something.
private credit too. Oh,
Yeah,
interesting.
so
Hedge funds, wow.
yeah,
Okay.
so these are kind of what's on the table.
Yeah.
It's still just a proposed thing, so we don't really know the nuts and bolts.
Well, one thing that's interesting, generally speaking, in the regulations within, the investment world, a lot of those things you have to be a qualified investor to put
Mm-hmm.
money into, and so they have different, rules about what that means. Certain amount of cash, certain amount of assets overall, certain amount of experience.
Yep.
So they don't want, the average person. So what they're saying here is that they're going to let the average person play around with some of these, particularly,
Yeah,
assets
and
and such
it'll
too.
always be up to the sponsors of the 401k to
Yeah.
to decide what these will be. But there's some pros and cons because it'll have more assets means more diversification.
Yeah, exactly. So,
But
uh,
is the complexity worth the?
yeah, I tend to be a bit more conservative when I'm looking at things. And so whether it's available or not, so theoretically, a lot of people probably don't know this, but your 401k at a lot of the companies that we've been dealing with, they also have another option called your brokerage 401k.
Yeah. And so if you wanted to get exposure to gold or like your cryptocurrency funds, you
Yeah.
would have options by doing a kind
Yeah,
of
'cause
self-directed broker.
normally there's a restricted list,
Yeah.
right? So when you go to the brokered 401k, you're at like Schwab, you can do anything, or Fidelity, or whoever it is. You can buy anything that's available. And so right now you can buy an ETF, that has Bitcoin in it through iShares, IBIT, I think it's called.
Yeah.
And then you've got, GLD, which is another, ETF. They buy physical gold and store it,
Mm-hmm.
for the shares and such too. So that's already available. What is new now is this, private equity, private credit, hedge funds, and so those are different. So, let's look at the pros and cons. So obviously, more asset classes means more diversification. No
Yeah.
doubt about it, right? It may favor the wealthy, and there might be a slow rollout that's coming as far as that goes. Returns, potential for higher returns, but obviously, you have more, risk
Yeah,
with those
y-
assets. That's why they're not in there now.
Yeah, you've seen crypto, the volatility of crypto, and so having that as a portion of it
Yeah.
could, it could juice your returns, but
Right.
it could also sap them too at the same time.
Yeah, and the fees are going to be higher. There's no doubt about that. I mean, so you have to have something that does really well to overcome those fees. I
Mhm.
mean, and so that fees have always been an issue that hang out there that doesn't get talked about enough. It can really, if you're normally paying 0.1% in that Vanguard, ETF that's on your approved list, and all of a sudden now you're paying 3% for some private credit or private equity or hedge fund.
Yeah, based on my understanding, what they want to do with the private equity, credit, and hedge funds is they make it into some sort of managed fund, and basically you buy that fund, and then that's how you get your exposure.
That makes sense.
It we don't know the whole like how it's going to work, but the idea is that you wouldn't have the individual investor picking these managers or stuff like that because they wouldn't have the ability to do it.
Yeah. So less disclosure, harder to evaluate, right? That's a generic concept of maybe not for some of that. I mean, you can buy the ETFs for the gold or for Bitcoin or whatever.
But private equity
Right.
definitely has a
Yes.
higher bar of, and then the information they release is not regulated as much, so it's harder to get good information.
Okay, so liquidity. This is my biggest point. I have never once purchased something that we couldn't get out of within 7 days. That comes from my grandfather. That was his thought. I managed to avoid the whole, limited partnership disaster that happened in the financial planning industry, even though they were trying to take you to dinner and they had all this money slushing around. And, they changed the tax law and just wiped those out. And we still have clients from practices that we've absorbed that have these limited partnerships and such that are still not liquid. And so I always worry about liquidity. Now, that wouldn't be true of that ETF with the Bitcoin or that ETF with the gold. Those are liquid. And it's more true with the private equity potentially,
Yeah,
right?
if the private equity has a lot of their money tied up in
Right.
private companies, it's hard to move those on a very rapid basis if there's a run on the investment in a sense.
Right. They probably just wouldn't allow it. I mean, that's the easiest way to do it. I've seen that before. Because they're going to go in, they're going to buy this company. Generally, let's say it's a 4-year deal. They want to get out in 4 years, 5 years, whatever it might be. You might be in that investment for that period of time. Now, sometimes they can do what you said. They can put it in kind of a fund, and then what they do is they have essentially money left over in the money market to accommodate kind of that average withdrawal. And that works out great. So there is, we give you quarterly liquidity or monthly liquidity so you can pull money out. And so, they manage the little cash fund that way. That's how they handle these and make it look more liquid. But then things fall apart. Too many people want their money out, and they only have, it's kind of like a bank. Bank only has 2 to 5% of their available deposits on hand at any time. They really can't go out there, and so that's where you get sort of that run on the bank, right? And the same thing can happen in any illiquid investment. It's why real estate has a problem sometimes too. I think that the one asset that I have purchased that I can't liquidate in 7 days, in the most cases, my own home, right?
Yeah.
But that's a good exception.
Usually you think of a home as more of a place to live,
Yeah,
a shelter, rather
that's right.
than
It has some
investment.
alternate uses. So, all right, so diversification, right? So we talked about that. Potentially reduces, public market risk, just because it's different asset class. Like Bitcoin, it seems to follow the market pretty well. I think it's just more aggressive version of the market has a higher beta.
It's a currency that kind of performs like a stock. I would
Yeah,
say. As
yeah.
long as there's faith
Right.
in it, it'll go up. It'll be stable or some a value there, and then as the market goes up, it can go up with it.
Gold has shown a diversification in general, but if you look closely at the very stressful times, gold's gone down too. And so it hasn't been a great diversification in some of those situations. So we'll see how that plays out. But suitability, so, the more sophisticated investor, this is going to be a boon for them to get access to this, but may not be appropriate for everybody.
Yeah, just like become a accredited investor, you have to have $100,000 of.
Right.
There's so many hoops to jump through, and there's a lot of things you have to do to just become suitable for these more alternative investments.
And I'm assuming those are going to be waived inside these 401ks.
I assume there has to be some way to make it easier to get around those regulations. Otherwise, it'd just be too strenuous.
And I think that's one of the things that'll be interesting to see how it plays out, because they have those rules in place to restrict the access to these.
It protects the average investor
Right.
because a lot of these are more liquid.
Right.
They also have more uncertainty with them,
Right.
more volatility.
So they're going to allow those people into these investments
Yes.
more than they used to.
So
with
that's
this
why I think the
avenue.
managed funds kind of is a way to compensate, to
Yeah.
have a professional investor kind of manage the money in a sense.
Well, and also one nice thing is it's in a 401k. 401ks do tend to be longer term assets for our clients. They don't look at them as a in and out thing all the time. They may move around within that 401k, but a lot of times, you don't even have to withdraw it until you're 73 years old. So, and that will be interesting actually in how this plays out, these illiquid pieces, and how they might impact that required minimum distribution for those older people that would like to do this. But for the most part, I think we're looking at people that are still working, that'll be adding money to their 401ks. And so I think that's probably okay. I don't have a huge problem with this. The more options, the better. But it just means that there's more complexity and more,
There's more ways that you can do something improperly.
Right.
I think for the average investor, keeping it simple is always kind of like, if you invest in the S&P 500 and in bonds, you tend to be okay. It's just if you do the savings, that's what gets you 80% of the.
All you need to do is look at the list of approved investments and how small it is within these 401ks, which for somebody like a professional like me is frustrating. I'd rather go to this brokerage 401k because I know what I'm doing. But I don't know what the percentage is, but I bet you it's 70+% of the people buy the target date fund.
And that totally works
right,
for them.
Right.
And And one thing that's interesting also too is a lot of times these private investments, you have capital gains as your tax rate, and this will be just ordinary income, so it could be a little bit more tax expensive and if you juice your returns in a sense.
I wonder if the target date funds could incorporate some slices of some of these alternative investments.
It's like pension funds kind of do.
Yeah, exactly right. Because then it's still liquid. Most of it's still in the stocks and bonds and other things, and you only have that 2, 3, 4, 5%
Yeah,
or whatever. in some of
especially if
these
your
alts.
funds are big enough, like
Right.
because like the California pension fund has like private equity
Yeah,
as part of
that's
their
right. Yep,
investment.
yep.
But because it's such a large pension fund, it
Right.
it has exposure to so many different things that it's not very much illiquid.
Right. Yeah. Unfortunately, a lot of those are Vanguard, and they're really conservative. I would be surprised to see them jump into the alt. Putting private equity into the target date 2045 would surprise me, but you never know.
Yeah.
So, okay, good. That's a great question.
What are your takeaways from the recent trade deals? Japan, I think Indonesia and the Philippines have come out with trade deals with the U.S.
Yeah, it's kind of interesting. First of all, you know, 10%, right, was the original flat rate after the pause.
Yeah.
Right? It was ridiculously high. It was half of your trade deficit before that. And so, now we're looking at, what was Indonesia at? I missed that one. Because I know Japan was at 15, Philippines was at 19, but all of them above 10%. And to me, this all revolves around two things. Number one is just what's the average tariff? Because we looked at this last week. The average tariff is now getting up into that 1930s area. If some of these tariffs that are sitting out there after August 1st become real, we're above that, and we're into the 1910.
Yeah, Indonesia is also 19%.
19%, okay. So, I mean, these are big numbers. I mean, they're just throwing them around. The market's celebrating because it's not 40% or whatever it might have been. But these are big numbers. So that's my biggest concern is like, if you look at historically, when tariffs get very high, they all of a sudden drop down because things are not going right. And so can we do that? All right. So that's the first thing that strikes me. A 15% tariff, for example, on Japan when we were at 1.6% before, that's a huge differential. That's, these complaints that we've had about like the Biden administration, and we had a 9%, increase in price and stuff.
The food at the grocery store is more expensive. Are we going to have something similar?
Yeah, exactly. So that's the first one. The second one, because they won't stay. I mean, historically, they haven't stayed. They're all pretending like this is going to be some massive revenue source, take over our, taxable. We don't need to pay taxes on a Fed basis. We don't have to pay taxes on our houses and all these great sounding things. It hasn't worked, okay? It has not worked in the past. Just look at the chart. But the second thing is just, at least in the Japan situation, they just made their cars cheaper than our cars.
Yeah.
Right? And so you've got the situation where in the U.S., the U.S. auto manufacturers are paying 25% tariffs on a lot of their pieces. Some is exempt in the USMCA, still at zero tariff for some of that pieces. But then they're paying 50% tariffs on some of their inputs like steel, copper, and aluminum, right? And so really put them at a disadvantage. I think that'll be rectified. I think they will lower those tariffs to make it so that the Japanese car manufacturers don't have an advantage. Because the same thing, if you do the same thing on Europe, right, a 15% tariff, those companies can come in with their cars with less tariff than a U.S. car might end up with, right? So we're supposed to be doing this thing where if you do it, in your own country, it's supposed to be cheaper, and at least the way those are structured, they're coming out to be more expensive. I think that'll be rectified. I do. I think that'll come through. But we haven't heard anything yet.
A lot of these American manufacturers have set up their products under NAFTA, where they were having across the three countries, or the MCA, and so the idea is that you have the entire North American continent as your manufacturing hub rather than a single country. Right,
which is brilliant actually, and it worked great because you got certain skill sets in different countries, different costs for labor in different countries.
Resources don't have to go as far for travel.
Yeah, and travel was, moving stuff around was easy. Regulations can be better one place or another for one type of manufacturing or what have you. And so it's too bad because I thought that was a fantastic setup, because the whole, Mexico, Canada, U.S. conglomeration is unbelievable. With lots of different powers in that 3, and striking that up and dividing that up and putting in tariffs into that is, you know, I don't think that's going to work as well, personally. So that's kind of my read on the tariffs in general. I just don't think that they're, and I'm not the only one. I mean, the polls are really negative on the tariffs. I mean, really negative. Across, even the Republicans don't like the tariff concept. And honestly, the public hasn't even remotely seen the impact of what's coming at them, this kind of wave of potentially higher costs.
We've seen it in the past with washing machines jumping in price, but now it's going to be a lot more goods that are going to be affected by it too.
Now, there's so many issues. So if you want to import steel, all right, it's a 50% tariff, okay? So you say to yourself, oh, I'm going to go to an American manufacturer's steel. But the American manufacturer's steel says, hey, the cost just, you know, the price just went up for all of our competitors coming from outside the country. Whoop. And so the American manufacturers raise their price also.
Yeah, they just have to undercut what's
Yep.
the import cost.
Yep.
So like
Right.
as long as they can just add more profit to themselves, essentially.
That's what happened with the washing machines, exactly that. So the American-made washing machines still became 5% more expensive on a 10% tariff on Chinese washing machines coming in. And so once the tariff disappeared, which it was finally taken out in May of last year, the price dropped back down 5%. So that's what the problem for the American car manufacturers. You know, they can't buy local-made steel that's all that much cheaper than this imported steel because these local producers. Now, if you have a stock in those producers, you might be doing pretty well. Cleveland Cliffs and some of those type of things could do well here. Of course, the tariffs then have to stay for a while for that to work, and then you
they
might
also
have
have
other
to
problems.
production to meet the demands.
Yes, right. Yeah, but it's more profitable possibly
Yeah.
than it was because they're able to raise their prices too. So those are some of the inefficiencies with tariff. It's why they're really on their way out for the most
Yeah.
part, and why things were lower, so much lower.
Yeah, it allowed people to specialize in like one product, basically one part, and then manufacture that only, and then supply the world with it.
Yeah,
essentially.
exactly. All right, I think we have time for one more question.
Should I think about an annuity if I am offered a pension from my job? So I'm getting closer to retirement, and I have some money that I could put into an annuity.
Okay, so pension, obviously, you retire, you get paid per month for the rest
Yeah.
of your life, or maybe some for your spouse. There's some different options you can choose within that pension. 100% life, 50%, to your spouse, 50 to you. There's all kinds of stuff. So you can do the same thing in an annuity. You can take a lump sum of money. It's what's called, in this particular case, there's a lot of different ways to do an annuity, but
Yeah.
let's just talk about an immediate annuity.
Yeah.
Make it simple. So an immediate annuity is you would take, a lump sum and you'd buy an income stream.
Yeah.
And the same thing, depending on your age and which option you take, depends on how much you're going to get out of that. You put in 100,000 or a million or whatever it is that you want, what you get per month and how long it lasts, depending on what options you pick.
Yeah.
And so, if you already have a pension, it is an annuity. Matter of fact, they're actually using insurance companies for a lot of those things where they'll go out and
they're annuity.
yeah,
Kind of
it's an annuitized, immediate annuity that the company has purchased for you in at least some cases. So, yes, you'd want to still do it potentially in two scenarios. Number one, your pension isn't that big. I mean, not everybody's pension is that large, right?
Yeah.
I mean, they didn't work at that particular company that long. But I think the second point is more important. You really, really value that consistent income, and you're willing to give up the potential that you could get out of some of these other investment arenas.
If you're more conservative and
Right.
you value stability rather than kind of potential returns, because if you're very heavily loss averse, annuity is great because you can't really
Right.
once you guarantee that income, it can't really go down for you.
Yeah, I believe it's still true, but that there's never been anybody that's had an immediate annuity payout that's been interrupted even by a failure of an insurance companies because they step in and help each other
Yeah,
out.
they basically have like a fund that they'll step in for other companies that each insurance company throws in money, and basically they'll bail out
Right.
these companies.
Yeah, I would say never, because
Yeah.
it's things are crazy sometimes. But yeah, in general, it's very, very safe. You would have to then also be liquid enough to afford giving that money away, or not giving it away, but having that money not be available, right? Because once you do an immediate annuity, if I put 100,000 or $1 million in immediate annuity, I'm getting this payment for some period of time, depending on what options I chose. but I can't get that money back. If I need, I need 500,000 out of that million, you can't. It's gone.
Yeah.
There's some places that will buy that cash flow stream, these factoring companies and stuff.
Yeah.
So in a dire emergency, there is some liquidity, but boy, you're probably going to take a big haircut to make that work too. So, no, I have no problem with that. I've not seen anybody do it over all the years that I've been doing this. I've never seen anybody really push for an immediate annuity. But in my position and watching all of these clients for 38 years, man, the ones that have income coming in from pension, they're the best retirements out there. Not a bad idea to consider, some of your assets into something that can produce this income on a regular basis. But we also don't see as much liquidity within the practice. Most people have money, but it's in these areas like 401ks and IRAs that are more difficult to get to as far as that goes. Although I think you could put an immediate annuity in an IRA. I can't remember if that's possible.
I think you could do that.
Yeah. So you could use some of those IRA assets or 401k assets to produce a consistent income. Okay, good. That's our show for today. I want to thank everybody for coming. Again, it'll be 3 weeks before we're back again, just because of vacations here during the summer. And look forward to being able to see you then. Send in your questions now, though, if you want. We can work on them, try to get ready for the next show and answer those. So again, ask Tom at talkmoneywithtom.com. Of course, you can go to our channel and see what we've already got on there, a couple thousand videos now. And you can subscribe. If you want to get notified of new content, there's a little bell there that you'd hit. And then, of course, lastly, if you just want to meet with Ethan and I, feel free. We would, be able to do that. You can go to our book appointment button on our website and set up a 30-minute time to talk with Ethan and I. So look forward to being able to see you in about 3 weeks. And again, I'll do, I think, the first 4 days of the daily videos next week. We'll see how that goes. So anyway, look forward to seeing you then. Thank you very much.